you wanted the best, you've got the best podcast, the hottest podcast in the world. The Chris Voss Show, the preeminent podcast with guests so smart you may experience serious brain bleed. The CEOs, authors, thought leaders, visionaries, and motivators. Get ready. Strap yourself in. Keep your hands, arms, and legs inside the vehicle at all times, because you're about to go on a monster education roller coaster with your brain. Now, here's your host, Chris Voss.
Hello, this is Voss here from thechrisvossshow.com. Ladies and gentlemen, he sings it, that makes it visual. Welcome to 16 years and 2,700 episodes of the Chris Voss Show. And why do we do it? Because we care, darn it. We care very much at making the world a better place, making you a better person, giving you the resources of the wonderful guests that we have on the show that uplift you, that change your life, or can change your life if you allow them to, but you might have to do the work. But they'll give you the ideas and all the gear you need. Refer the show to your family, friends, and relatives. Go to goodreads.com/Chris Voss, linkedin.com/Chris Voss, facebook.com/Chris Voss, youtube.com/Chris Voss. Opinions expressed by guests on the podcast are solely their own and do not necessarily reflect the opinions of the host or the Chris Voss Show. Some guests of the show may be advertising on the podcast, but it is not an endorsement or review of any kind. Today, an amazing young man on the show with us today, sharing his insights and how you can be more wealthy. Because last time I checked, everyone needs money and has bills. What is it? Death and taxes are the thing that everyone has. His book is entitled Beat the Wealth Management Hustle. Invest independently to grow savings faster with peace of mind, out January 16th, 2024 by Andrew D. Parrillo. We're going to get into it with him and find out more about the deets, as the kids say. I don't know if they say that. Andrew was an institutional investor for over 4 decades, the last 25 years of which were with his own registered investment advisor firm, Newport Capital Advisors, LLC, that served endowment funds and family investment offices on a discretionary and non-discretionary basis. The problems that he has solved for former clients and wants to solve with this book are to eliminate the anxiety that individuals may feel about investing, to eliminate or greatly reduce their ongoing fees, and produce optimal outcomes with their money. Welcome to the show. How are you, Andrew?
I'm great. How are you, Chris?
I am excellent. It's wonderful to have you. Give us your .coms. Where can people find you on the interwebs?
Yeah, it's PARRILLO, investors.com. And yeah, my website's got a lot of stuff on it. A couple of things that you could access immediately to help out with what you're doing. Mm-hmm. I could go a little more into it if you want, but
we will. You got the mooch, Anthony Scaramucci, to write your forward. That's pretty awesome.
Yeah, he's a friend of mine. You know, he and I, there's no daylight between the way he thinks about investing and the way I think about it. And the book talks about it a little bit, but we had crossed paths for the last 26 years actually in the business. So anyway, he's become a friend, and I know he's a little controversial, but he's a super smart guy, and I respect him enormously, and I'm grateful for his foreword to the book.
Yeah, and without him, we wouldn't have mooch time or Scaramucci time. 10 minutes or 10 days or what was it, 10 days or something like that? But yeah,
11 days. Yeah. 11 days. Scaramucci is 11 days, right? Yeah.
We now have a new term for 11 days. We had, the fortnight was 2 weeks, a month is a month. Now we have Scaramucci. But we tried to get him on the show, I think, years ago when he launched his book and stuff like that. But he's got his own great podcast too, from what I understand. So we've had a couple people that started great podcasts about the time they launched a book. We're like, we want to get you on the show. And they're like, I'm doing it on my own podcast. Andrew, give us a 30,000 overview. What's inside this book? Beat the Wealth Management Hustle.
Well, okay. It's basically discussing my reality in business for over 4 decades, working as an investment advisor. Last 25 years of which was with my own firm. And so what did I learn? I learned a lot of things, but one of the things I came away with is something that's really simple that I want the folks listening to this to really take to heart. And that is that you don't have to be intimidated about investing. You don't need Wall Street's permission to invest your own money. Invest independently and generate competitive returns, with paying almost no fees, using the major firms to access some very solid, prudent vehicles like ETFs. And so why do any of that? And so anyway, so I learned this over, decades of working with real money, going through bear markets. Hey, very few people who are investing today have actually seen a bear market. And one of the things that, I'd like to talk about is that, over the last 100 years, the Standard & Poor's 500 has produced a return of 10.4% a year. Now, we all know that that's not a straight line, okay? We know that that comes with a lot of tests. So if you're going to be involved in the market, you better understand what you can expect. And I will guarantee you that you will be tested, okay? And so I can't guarantee anything else in life except death and taxes, but I can guarantee that if you're in the stock market, you're going to get tested. So if you don't know who you are, don't find out in the stock market, folks. Figure it out. And the other thing I say is understand your tolerance for risk before you exceed it. All right. Well, how do you do that? Well, yeah, we can talk about that too. There's a really simple way to get at that, and one is it's a complimentary, no obligation 5-minute questionnaire on my site. What it does is it asks a series of questions. So these are based upon a Nobel Prize winning theory called prospect theory, and it's Daniel Kahneman is the psychologist who got the Nobel Prize for that. But basically, it's just a series of questions that helps you determine what your tolerance for risk and preference for return is, or preferences are, and it creates a score. So instead of coming away with a questionnaire which says, okay, well, you're X years old, therefore, and you have these various things going on in your life, therefore you're an aggressive investor, or therefore you're a conservative, or therefore you're moderately aggressive. Well, none of those subjective terms mean anything. And what do they mean when you actually put a portfolio? What's a portfolio for an aggressive investor look like? Does it have 100% of its assets in one stock that's really volatile, that's done really well, or does it have a diversified portfolio? What does it have? What does it look like? And here's what that's important for. Okay, I've had people complete that questionnaire and come up with a risk score. And the risk of the Standard & Poor's 500 is about 72 on a scale of 0 to 99. Okay? And so this particular person had a risk preference of 68. And I looked at his portfolio, and this gentleman was 65. He was ready to retire. And his actual portfolio had a risk score of 38. Well, what does that mean? Well, what it meant for him is that he, in his particular case, left about $1.5 million on the table over the last 10 years because he didn't have enough risk. Oh, wow. People worry about having too much risk, but there's just as much risk in not having enough risk in the world. Okay, so, and that's what this gets at. And it's not like me making some judgment about somebody. It's the person answering the questions derives their own score. It's sort of investing by the numbers if you want. I mean, if you can follow a recipe, you can do this. It takes 5 minutes.
There you go. Go ahead. One of the biggest problems with in the stock market, from the way I understand it, and I hear this a lot from investors, is, you've got to be logical and reasonable in the investments that you make and what your long-term goals are. If you let emotion run your market, is that factored in your risk scoring when you look at people? There's bad days you're going to have in the market, but usually those days recover. And, is that a factor in the thing?
That is the factor, Chris. That's the factor. It's basically, how do you know? First of all, we want to know what to expect in life. In your car, you want to know what to expect when you drive down the street. All right. You get, whatever you're doing, we want to have some idea what to expect. And the same is true when you invest. But, most people just don't know. And what this does is this analysis will basically tell us, and that, you can have a complimentary session with me after you do the score. And, we'll say, and I'm not going to try to sell you anything. You don't have to do anything. You don't have to pay me for advice. Okay. Just do the risk score. And what it'll do is it'll then say, it'll give you a projection over the next 6 months. Okay. So with your $100, it may be up, I'll make up some numbers, up 20 or down 10. Is that okay? Can you live with that? Well, I don't know. Being down 10 is a little too much. Okay. Well, let's recalibrate. Let's say you're up, 15, but you're only down like 8 or 7. Well, that sounds a little better, and then so you do that. So then you come up with a projection over the next 6 months based upon probabilities, based upon what's happened in the past, because we don't have anything else to go on. Okay. Why is that important? Because human behavior does not change. Okay, over time, it does not change. People go from fear to greed, and greed to fear, and everything in between. So what we're trying to figure out is the midpoint of that is like, okay, here's what you can expect over 6 months. Here's what you can expect over the next 5, 10, 15, 20, 30 years, okay, when you model this out, and, we do that. But what's really important is what's going to happen when the wheels come off, okay? What are you going to do? You're going to be really terrified. You're going to feel horrible, and you're going to say, oh my God, what do I do now? Because the only person coming to save you is you, okay? And you have to have the discipline and the resilience to stay on your course. And I think, as I mentioned to you earlier, when people set up investment plans, they have a great plan, and but then they're not ready for the test. But what this process does is it gets you ready for the test that you will experience. Yeah. So it's kind of like, I was in the hills back a few years ago. One of these Go Fast motorcycle kids they had a T-shirt on. It says, "It's not when, but if and how bad." Okay. So when you're on a motorcycle, it's not when you're going to go down, but it's if you're going to go down, when you're going to go down, how bad it's going to be. And the same question you have to answer for yourself with your investments is, it's not if, it's when it's going to go down, and how much can you handle. Okay. That's it. So it will happen. I'm not going to make an apology for being invested, and this is not a get rich. Right. Why do this at all? Okay. Because, in the last 10 years, if you put $100 in the S&P 500, which is easy to do through any major firm, you could do it by transferring money this afternoon to your account and buying it later in the day. And if you put $100 in 10 years ago, it would have been worth $395. Okay. At the end of the year. Okay. Now that's a 14.7% a year. Now the stock market's not going to do that for every 10 years. And in fact, for the 10 years after the .com crash, you didn't make any money at all for a decade. So, but the people that stuck with it profited enormously. Okay. Yeah. So why bother doing that? Because if you didn't do that, your dollar 10 years ago, your dollar bought a dollar's worth of stuff. Today, it would buy, in 10 years, you would be down, 33% in purchasing. So, your dollar would buy 68 cents worth of goods. Yeah. Now we know that, so everybody complains about, everybody complains about the weather, but nobody does anything. Well, everybody complains about inflation, but nobody does anything about it. Well, you can do something about it, folks. You can't do it tomorrow. You can't do it for next year, but you can do it over the next 3, 5, 10 years. And because over the last 100 years, the Standard & Poor's 500 has gone up over 10.4% a year. And that's with the Great Depression, with .com crash, with the Great Financial Crisis, with the COVID crash, and it comes back. And why does it come back? Because you've got 500 of the best, hardest working corporate managements in the world working for you if you want 500. So you can hire those 500 managements for almost no money at all. It costs you 0.03% at most of the firms a year. Okay. And then what's the other part of the book that I'm talking? Beat the Wealth Management Hustle. Well, if you're paying 1% to a so-called wealth manager, you can easily figure out what that's going to cost you over time. And there's a calculator on my site. It takes you 30 seconds to do the calculation. What does it cost? Let's say I've got $100,000. I have it at 1%. I'm going to make 7% a year. What's it going to cost me over the next 10 years? Well, this calculator will tell you, and the answer, by the way, is that it's going to cost you $187,000 on your $100,000 over 10 years. Yeah. And so people don't know that compound interest is a killer, even at 1%. So it's just real simple stuff. I promised earlier I'm not going to do any brain damage with a lot of statistics here, but I'm just trying to keep it simple. And don't be intimidated. And and I'm not the first person to say this. Of course, Warren Buffett is saying this for years, and he's a pretty astute gentleman. And it's like you got to be patient. And you got to be resolute. And so, but what I do is I try to keep it simple for folks. I tell some stories in the book, all right, what's my claim to fame? Well, I don't really have a claim to fame except that I was consistent with what I did in my life. Yeah. And so I'm not, there's no secret sauce when you invest. Okay. There just isn't. And I know it's easy to be confused. There's a lot of confusing information. It's intimidating. And the other thing that's going on here, and this is what prospect theory holds, people are 2.5 times more concerned about losing money than making money.
That's an interesting angle.
And so that's really the basis of this questionnaire. Okay, it understands that, and so why do people go out and hire wealth managers and pay them a fee every day of their lives as long as they have them? It's because they feel more comfortable doing that because they're intimidated to do it on their own. But does the wealth manager have some secret sauce? Does the wealth manager? And so here's the question: if you have a wealth manager, please tell me what my return is over the last 1, 3, 5 years after your fees, okay, compared to a market index.
Mm-hmm.
And if they can't give you, that's one number, okay, or two numbers, the market index return and your return. They're two numbers. And if your return after fees is less than the market index return, then you have to say, well, ask yourself, well, why are you paying this person this money? Which I said over a relatively short period of time is, on $100,000 over 30 years, it's going to be 187. I mean, you can do the math on my site. It takes you literally 5 seconds, but most people don't do it. And I would also say that most investment sites, most advisor sites do not have that calculator because they don't really want people to know how much it's costing them over time.
Yeah.
You should also ask, how much have I paid you over the last 3 years in fees? Simple. I like to keep things simple. I'm not a mathematician. I'm not a statistician or any of that stuff. I just understand that some basic numbers here. They're stubborn facts. Okay, and I'm just dealing with stubborn facts, and so it's really simple. So just ask some simple questions of your manager, and I guarantee you that you will feel a lot better after you do, whether you keep that manager or not. You'll have a better relationship with that manager. The manager will know where he or she stands, which is always important to know what to expect from each other. And so I'm not against wealth managers. I'm just saying, hey, look, if you're going to make money for the client, that's after your fee, that's great. But if you're only there to make money for yourself, then that's not so. And if you're there just to give some comfort, this kind of, well, I feel more comfortable using this big firm. Is that a reason? Maybe that's a reason, but I don't think it's a good enough reason. Anyway, that's it. And that's, hey, look, this is coming from somebody who made his living charging asset-based fees. Okay? and by the way, the clients I had were endowment funds and wealthy families. So they didn't stand still unless they made money after they paid their fees. Yeah. So that's the world I lived in. Yeah. And that, unfortunately, that's not the world that that a lot of these so-called wealth managers live in. And by the way, that industry, it's at now about a $300 billion a year industry. So you have to ask yourself, how much do they actually add $300 billion of value to invest to their investor clients? Maybe they do. I mean, I hope they do.
Hopefully they do.
So you just ask the question. It's like, it's kind of like Will Rogers said, I'm not concerned with the return on my money and capital. I'm interested in the return of my capital. So it's just simple questions, simple answers, nothing fancy.
And let's talk about the dissolution of money with inflation and the dollar dropping. I think we've seen, a 10% reduction in the value of the dollar since Trump took office. We're in 2026 right now, if you're watching this 10 years from now, from your cave or something.
Well, okay, there are two things here. One is the external value of the dollar, which is about 10% since President Trump took office. And what does that mean? Well, it means that, theoretically, it means that people who buy goods from us pay 10% less than they did a year ago. But it also probably means that, if we're importing goods, it's going to cost us more money to buy that imported good because the value of our money is down. Yeah. So the more important aspect of the value of the dollar is, what is it buying us today in the good old US of A? Okay. And that is something that, as I mentioned earlier, in the last 5 years, the value of the dollar is down. It's actually down 19.7%. Okay. So you've got 80 cents of purchasing power versus 5 years ago. And that's according to the U.S. Consumer Price Index. Now, I don't really believe that index is accurate. I think most folks would say, hey, inflation's a lot more than that for me because I see my bills every month and it seems like they're going up more than that. And I think they are. So that's even more reason to think about saving money for the long haul. Or don't just save money. If you just put your money in a savings account, you're not going to keep up with inflation. You're just not. And if you put it in stocks, you're gonna, and particularly if you put it in an IRA or a 401k account, you're not going to have to pay taxes on it, and you're going to compound at a really great rate of return over time, recognizing that you're going to have some years where you're down. You're absolutely, you're going to be down. So it's not going to be. Now, what's going on today? Is the market, are we ready for a big crash? I don't know. I don't know. Nobody really knows. But the one thing I do know is that bear markets have been shorter than bull markets.
Yeah.
Now, the bear market we had after the dot-com crash actually went on for about 9 years.
Oh, wow.
Yeah, you didn't make any money in 9 years in stocks if you invested at the top of that market.
Yeah.
But if you kept investing throughout the decline, so-called dollar cost average, which is a pretty standard approach, most people understand, then you did pretty well, And again, why is that? It's because you've got these corporate managements that are working really hard for their shareholders. And eventually the stock market recognizes those efforts and recognizes those returns, and it rewards them with, in the stock price. That's the way it is. That's just, I try to keep it simple, and it's just, and also the other thing is you cannot control what's going to happen in the future. You can control how much risk you take, and you can also control how much expenses you incur to invest your money. And, think about this. If you make 10% a year, but you're paying somebody 1%, let's say, so that means, let's say I'm paying them 10% of my profits to manage my money. Are you really ready to do that? Or if you're only making 7% a year, you're paying them like 15% of your profits to manage the money. Look at it that way. So that's, but people don't do that because I can't, I'm just going to go to the wealth manager because I feel good about them. And they're really nice people. They're good. They're presentable. They're articulate. They're well dressed. They have nice offices, or nice, to work from. And, there's this great comfort factor there, but understand that, and that's fine. If that's what you want to pay for, that's good. It's like the difference between buying a more expensive vehicle and a less expensive vehicle. I mean, it's always subjective. It's subjective. And I'm just saying that, but there's always objectivity that becomes in play when you're making any decision. And I'm just telling people that try to be objective, try to remove the emotion from the process. And that's it. I mean, it's not rocket science.
Emotion is a poor guide for making decisions. I think I see a lot of that in dating. Now, you had a graph that you wanted to, I think we were talking about in the pre-show. Well, do we want to put that up? Or?
The folks that are listening aren't going to be able to see this, but basically what the graph is, it's 2 lines, over the last 50 years. And the graph, if you want to put it up, we can take a look at it. But
let me put up here as you're describing it. Let's add to the stage, and let me change the format of the overlay so we can see the full. There we go.
All right. So it's really straightforward. It's if you have 50 years ago, and that's just an arbitrary number. I mean, I could have picked 20, 30, 100, whatever. But 50 years ago, $100 invested in is now going to buy $16.69 worth of goods. Okay. But if you have if you put $100 in the Standard & Poor's 500, you would have $28,795.
Oh, wow.
Yeah.
Wow.
Yeah.
It's quite a difference, 16 and 28,000.
Yeah. No, I mean, you made a lot of money and you beat inflation, of course. But what you'll notice from that graph, which unfortunately your listeners cannot see, but your $100 basically peaked in value in the late 90s. Okay. Call it the dot-com peak. And it didn't come back to that level for another almost 10 years. Okay. And that included, by the way, the great financial crisis crash. Those were 2 50% crashes in the stock market in a decade. Right?
Yeah.
But if you hung in there, you came back. So if you held in after the great financial crisis, you can see where the line goes. It goes up. And it's not always going to do that, but over time it will, for reasons I mentioned. You got these corporate managements that are working really hard for their shareholders and themselves. That's just the way it is. And the really cool news about this whole thing is 50 years ago, it wasn't that easy for people to invest in the market.
Yeah.
Okay. Today it is. Okay. You can call any of the major firms and they're super helpful and it doesn't cost much of anything. They'll give you basically complimentary advice on how to do what you want to do. They won't necessarily tell you how to invest your money, but they'll tell you if you say, I want to buy some of the S&P 500, how do I do that? They'll show you how to do that. Do that for almost no fee at all. And the other thing that's cool about these sites is you can monitor your portfolio on them. So you don't need a money manager to do that. You don't need a wealth manager to do that. You can do it yourself. And I don't have the time for it. Well, listen, if you have the time to pay your credit card bill or look at your credit card statement, you have the time to do this.
Yeah.
That's just the way it is. So I just like to keep things simple, and and the other thing I'm trying to do is I am single-handedly trying to disrupt a $300 billion industry.
Oh,
yeah.
Well, you can lose a lot of money, if you eat up the ROI on your portfolio. There's people that do feed to death or get feed to death out there. And so you got to be careful. You got to advocate for yourself and everything. Would you say that's kind of what this book does? It helps you advocate for yourself and understand the hustle of wealth management. So you don't get, with somebody who's going to soak you in fees too much and they're just churning your portfolio for, to make fees.
Well, here's another way to look at it. Okay, so you got. Let's say you have $1 million. Let's use the big number, $1 million. 1%. That's 10,000. Okay, so let's say in 10 years it grows to 2 million, but you're still paying 1%. Well, that's 20,000. So let me ask you. Ask your manager: are you doing twice as much work for me now that I have more money as you were before I had all this money? And the other thing I'll tell you is Warren Buffett's favorite holding period, in terms of talking about churning or making changes in the portfolio, that most strategies, that is not required for the vast majority of investment strategies. You can just stay invested, be patient. So your superpower, as I started out this conversation, Toby, your superpower is being patient and being resolute. That is your superpower. And everybody listening to this has that superpower. Mm-hmm. And we joke about, I want to be able to do this and fly around over the house and stuff like that. No. This is actually a real superpower that people have. And you can measure it, and that's the measurement. The truth of the proof is in the pudding. The proof is, like, over time you will do well. So that's really where I'm coming from. To me, it's not easy. Okay, if you want a coach, that's what my service is about. It's a fixed fee. You don't pay me every day. You just pay. It's like when you hire a CPA or a lawyer, you pay them one time, and you know what they pay them, and you know what they do, or you should know what they do. But they don't charge you every day. It's like, if do you pay your dentist 1% of your assets every day? I mean, no, you don't. Does he fix cavities every day? No. And so, but these wealth managers, this fee structure, it's a legacy fee structure that has not changed. Now, we know we didn't have Amazon 25 years ago, or maybe we just 25 years ago, but now we use it. Most of us use it. It's a very efficient way to buy things, and we trust them, and they have transparency of pricing, et cetera. We have lower costs of many things like phone service and such, which we didn't have then. Most of us. But what has not changed is the fee structure of the wealth management industry, and it's a super profitable industry, and they advertise heavily, and they have a great sales force. But just, basically, here's what I would leave people with. If Wall Street's selling it, I'm not sure I want to buy it. That doesn't sound very kind, but do you think Wall Street's going to be kind to you? I hope you don't, because they're not.
Yeah, there's a lot of different things that go on in Wall Street and stuff like that. So when people reach out to you, tell us about some of the offerings you have on your website. I see some things here where, of course, you can order the book. There's 14 questions every investor should ask themselves. There's a way to figure out your risk score. You can press a button to figure that out. Talk to us about some of the offerings on your website people can utilize.
Well, the risk score is the most valuable thing there is there. And again, it's complimentary. It doesn't cost anything. You have to put your email in there, but I don't send out blast emails. I don't do that. Okay. Yes, you have to put your email in there, but you're going to get something that is meaningful. And then we could get on the phone and talk about it, and we'll look at your portfolio, and again, complimentary, and you can see what your portfolio actually is. What is the risk score? The other thing it has is it has a fee calculator that literally takes about 10 seconds to do. So you should do that. Mm-hmm. There are a couple of videos on there, interviews with me. There's a couple of articles I recently posted there that I published within the last few months that talk about this. But again, this sounds awfully complicated, and I don't mean it. I want it to be simple. Put your money in the stock market and be patient.
Be patient. Yeah.
Be patient. That's what you got to do, and and I can help you do that. Or you can do it on your own. But if you have a wealth manager, you've got to go out and ask some questions. And those questions are pretty clear. I already told you one of them to ask. So it's pretty simple stuff, really.
Yeah, there you go.
That's my message, Chris. I hope it benefits people of all different levels of wealth, if you want. Okay. And it can and it should. So that's it. So I'm so appreciative of you giving me the opportunity to say this to your audience. I really am. Thank you.
Thank you. And thanks for coming on the show. So give us the .coms one last time as we go out.
Yeah, it's Parrillo, 2 R's, 2 L's, ParrilloInvestors.com. And that's where you're going to find everything you probably need to know about me. And that's professional stuff. I'm not going to know about my dog, but, or my weightlifting or my, other stuff, tuna fishing.
Hey, that's a whole other show. Your weightlifting. There we go.
Yeah. Well, I happen to use this guy called Mark Ripito, Starting Strength. He's in Wichita Falls.
Oh, really?
I've been doing that for a decade. Yeah. It's just barbell training. It's cool.
Well, fun is fun. Well, thank you for coming on the show, Andrew, and sharing a lot of your context and knowledge. And, of course, a way the people can reach out to you to help. I'm sure everyone's going to want to go check out what is your risk score on the thing there so you can figure out how to get good advice. And, yeah, there's a lot of high fees, so hiring a coach or consultant is much better, probably cheaper in the long run, especially if you can advocate for yourself. I've done my own investing. I did day trading during the .com era. That was fun. It was so easy too in the mornings, but anything that was launching that was tech would go, through the roof. But that ended very quickly. Unfortunately, I got out at the top. I saw the crash coming. But it's advocating for yourself, understanding what you're doing can really empower you because emotional decisions. You see a stock, down 10 points. I should probably sell. It's who knows how low it could go. But it's interesting what you said is people think more about losing than gaining, and they probably go in that panic thing. So thank you very much, Andrew, for coming to the show. We really appreciate it.
Well, it's my pleasure. Thank you, Chris.
Thank you. And thanks to our audience for tuning in. Order the book wherever fine books are sold. It's called Beat the Wealth Management Hustle. Invest independently to grow savings faster with peace of mind. Out January 6th, 2024. Thanks so much for tuning in. Go to goodreads.com/Chris Voss, linkedin.com/Chris Voss, youtube.com/Chris Voss, and all those crazy places on the internet. Be good to each other. Stay safe. We'll see you guys next time.
You've been listening to the most amazing, intelligent podcast ever made to improve your brain and your life. Warning, consuming too much of the Chris Voss Show podcast can lead to people thinking you're smarter, younger, and irresistible sexy. Consume in regularly moderated amounts. Consult a doctor for any resulting brain bleed.
All right, Andrew, we're out. This will be